For decades, the truly wealthy have played a different financial game than the rest of us. They have access to tools and strategies that are simply not available to the average person. Since the 1960s, these individuals, along with major corporations, have understood the power of leverage using borrowed money to amplify their own investments. They would strategically finance large life insurance policies, not just for the death benefit, but for the powerful cash accumulation features hidden inside. This wasn't about just buying a policy, it was about using the bank's money to build a massive, tax-advantaged asset. It was a sophisticated move, one that required significant capital and connections, keeping it exclusive to the highest echelons of finance. This strategy, known as premium financing, allowed the wealthy to control a much larger asset than their out-of-pocket contributions would suggest. Think about it. They would put in some of their own money, and then a bank, seeing the stability of the life insurance policy as collateral, would lend the rest. This created a much larger pool of money working for them from day one. The goal was to have the policy's growth outpace the interest on the loan, creating a significant net gain over time. This is how they built fortunes and protected their legacies, using the very structure of the financial system to their advantage, a strategy that remained largely behind closed doors for many years. The problem was that this powerful tool was out of reach for most people, even highly successful professionals and business owners. To get a bank to finance a multi-million-dollar insurance policy, you needed to already be a multimillionaire. The barriers to entry were incredibly high, requiring substantial net worth and the ability to personally guarantee a large loan. This created a clear dividing line in the world of financial planning. On one side were the ultra-wealthy, using leverage to accelerate their wealth creation. On the other side was everyone else, relying solely on their own contributions to save for the future, a much slower and more arduous path. But today, that is changing. The core principles of that exclusive strategy have been redesigned and made accessible to a broader group of high-income earners. This is where the Kaizen strategy comes in. It takes that same concept of combining bank leverage with permanent life insurance and packages it into a program that doesn't require you to be a billionaire to participate. It's designed for doctors, lawyers, executives, and entrepreneurs, people who earn a great income but haven't yet reached the level of wealth needed for traditional premium financing. Kaizen opens the door to a strategy that was once reserved for the financial elite, giving more people a chance to build substantial wealth more efficiently. So, how does Kaizen actually work? Let's get into the nuts and bolts because you must understand this. The core idea is simple. For every dollar you contribute, a bank will contribute more. Typically, for the first 5 years, you make your personal contributions. Then, the bank matches those contributions and adds even more funds on top, often lending $2 or $3 for every $1 you put in. This means if you contribute $40,000, the bank might lend an additional $80,000, creating a total contribution of $120,000 into your policy. This is not a suggestion. It is a structured financing arrangement that immediately multiplies the power of your savings. This powerful combination of personal contributions and bank financing continues for a set period, usually the first 10 years. During this time, your contributions and the bank's loans work together to purchase a specially designed life insurance policy. The result is, you're funding a policy significantly larger than what you could afford on your own. This accelerated funding supercharges the policy's cash value growth right from the beginning. Instead of slowly building up cash value over decades, you're essentially jump-starting the process, giving your money a much bigger base to grow from in the critical early years. Now, I know what you're thinking. Suze, what about the loan? I don't want to be in debt forever. And you're right to ask that. This is the smartest part of the strategy. The loan is not repaid by you out of your pocket. Instead, after the initial funding period, the loan is designed to be paid back using the policy's own cash value. The policy is structured so that after a certain number of years, typically around year 15, a portion of the cash value is used to completely pay off the bank loan and all its interest. This leaves you with a substantial, debt-free asset. Once that bank loan is satisfied, the remaining cash value is all yours. You're left with a fully paid-up life insurance policy with significant cash value that you can access. You can take tax-free loans or withdrawals from this cash value to supplement your retirement income, pay for college, or fund other major life goals. You have effectively used the bank's money to build yourself a larger asset, paid the bank back using the asset's own growth, and are now left with the remaining equity. It is a sophisticated financial maneuver that turns a traditional insurance product into a powerful wealth-building engine. A financial strategy should not just be about growing your money, it must also be about protecting you and your family. This is an area where the Kaizen strategy, because it is built on permanent life insurance, truly shines. Beyond the cash accumulation and death benefit, these policies come with what are called living benefits. These are provisions that allow you to access a portion of your death benefit while you are still alive if you suffer a qualifying critical, chronic, or terminal illness. This is not a small thing. A serious health event can destroy even the best-laid financial plans, but this feature provides a crucial safety net. Imagine getting a diagnosis for a critical illness like a heart attack, stroke, or cancer. The medical bills alone can be overwhelming, not to mention the potential loss of income if you are unable to work. With a Kaizen policy, you could accelerate a portion of your death benefit to receive a lump sum, tax-free cash payment. This money can be used for anything you need, to pay for top-tier medical care, cover household expenses, or simply reduce financial stress so you can focus on your recovery. This transforms your life insurance from something that only benefits your heirs to a vital tool that protects your financial well-being during your lifetime. Furthermore, let's talk about how the money inside the policy actually grows. This is not your standard whole life policy with a tiny fixed interest rate. Kaizen typically uses an indexed universal life, or IUL insurance policy as its chassis. This means the cash value's growth is linked to the performance of a stock market index, like the S&P 500. When the market goes up, your cash value is credited with interest, often up to a cap rate. This gives you the potential to capture much of the market's upside, allowing your cash value to grow significantly in good years. Here is the most important part of that crediting strategy. You get the upside potential without the downside risk. The policy has a guaranteed floor of 0%. This means that even if the stock market index has a negative year and crashes, your cash value will not lose a single penny due to that market downturn. You are protected from market losses. You get to participate in the market's gains, but you are contractually guaranteed not to participate in its losses. This unique combination of upside potential and downside protection is a cornerstone of the strategy's appeal for those who want growth but are not willing to risk their principal. All right, let's have a straight talk. While the Kaizen strategy has powerful benefits, it is not a magic wand, and it is absolutely not for everyone. This is an advanced strategy, and you must go into it with your eyes wide open to the risks. First and foremost, the entire plan is built on projections. The illustrations you see will show how the policy is expected to perform based on certain assumptions about market returns and loan interest rates. These are not guarantees. If the market underperforms over a long period, the cash value may not grow as quickly as projected, which could impact your ability to pay off the loan and the final amount you have left. Another significant risk involves the bank loan itself. The interest rate on the loan is typically variable, meaning it can change over time. If interest rates rise significantly, the cost of borrowing will increase. This could eat into the policy's growth and potentially require you to contribute more money or hold the policy longer than originally planned to pay off the loan. You are relying on the spread between what your policy earns and what the loan costs. If that spread narrows or inverts, the strategy becomes less effective. You must be financially stable enough to handle potential changes in the loan terms without it causing you financial distress. You also need to understand that this is a long-term commitment. This is not a get-rich-quick scheme. It is a strategy designed to build substantial wealth over a 15 to 20-year period and beyond. If you think you might need to access your contributions in the first few years, stop right there. This is not the place for your emergency fund. The early years are all about funding the plan, and the cash value is not readily accessible until after the loan is repaid. You must have the discipline and the financial stability to see the plan through to its intended conclusion to reap the rewards. In conclusion, the Kaizen strategy can be a phenomenal tool for the right person. It offers the potential for greater wealth accumulation by leveraging the bank's money, provides tax-advantaged growth and distributions, and includes powerful living benefits for protection against illness. However, it is an advanced strategy best suited for high-income earners who have already maximized their traditional retirement accounts and have a stable financial life. You must understand the risks, that projections are not guarantees, loan rates can change, and it requires a long-term view. If you fit that profile and understand the trade-offs, it is a strategy that is absolutely worth investigating. More information, call Robert Campbell for a consultation, 954-802-0265.